Hey folks, my name is Chris at Hauseit. Today we're going to talk about an interesting topic, and that is, how will the Fed raising rates affect home prices? Well, this is a pretty interesting topic, and I first recommend that you watch another video that we recently released about why we think the Fed actually won't raise rates or raise rates much. But let's assume that they do, they follow through, and they have credibility, they follow through with what they're saying they will do in terms of the number of rate hikes and the balance sheet reduction that they'll do over time. This leads to a significant tightening in the economy and an increase in borrowing costs. And that is the first thing to take note of in the real estate market, because you've often heard mortgage bankers say, hey, our mortgage interest rates are roughly based off of or have some correlation per their internal models to the US 10-year Treasury note. That's the most liquid Treasury instrument out there, debt instrument out there, and that's the most frequently referenced one. So, a lot of mortgage rates are impacted in some way by that reference point. And even though the Fed is raising interest rates on the short end, which is what they control, ultimately, assuming that they're doing it because the economy they think is in good shape, there are inflationary pressures, oftentimes you might see the longer end and the mid end of the curve rise as well. Now, of course, other things can happen as well. I mean, the Fed can raise rates, and you see this in more sort of typical recessions where the short end of the curve goes up. People are incentivized to go hold cash and such, and sell longer dated assets. And then this inverted yield curve can happen when people forecast recessions, and then ironically then the sort of the 10-year and the 30-year can be lower than the short end of the curve. But let's not get into that so much. Let's assume that the Fed knows what they're doing. They raise rates. It's a strong economy. Things are running hot. The yield curve is upward sloping, so which means them raising the short end of the curve, the 10-year and the 30-year, they're going to be higher as well, which affects mortgage interest rates. So this all leads to mortgage rates being higher. And when that is the case, the obvious knock-on effect is it's going to be tougher for a lot of buyers who are financing with mortgages to afford their monthly payments as much, because it's a significant difference, from say 3.5%, 4%, 4.5%. I mean, these are big changes in monthly payments for a lot of buyers. Not everyone has sort of unlimited liquidity to afford these. So, it definitely reduces the, many of the marginal buyers, especially, who might have stretched a bit to try to purchase a home they really love. But, with those higher interest payments, they might not be on the margin anymore. So it reduces the buyer pool, essentially, makes it more expensive, and ultimately, reduces what prices can sell for. So, in sort of a sort of normal situation, then you would expect this to cause home prices to fall. Now, what's interesting is, oftentimes during these more traditional recessionary cycles, when the Fed is actually able to raise rates, and this is what you've seen prior to today, and we really are, I believe, in uncharted times with interest rates at zero, and we think it's going to be very difficult for them to actually raise rates to something more normal. But in normal, in a more sort of normal long-term cycle, what typically happens is the Fed is able to raise and lower interest rates to manage these cycles. But as you've noticed over the past, say, couple decades or so, every time they've done so, the lower bar for the lowest interest rate they go to during the bottom of the easing cycle is always lower than the last, eventually ending at 0%, where we are essentially today. But anyway, in a more normal cycle, what typically happens is, when you raise rates and such, they've typically raised it to a point where then they break something. So, increased borrowing costs and such throughout the economy eventually leads to some pricking of, any bubbles that have formed. Increased borrowing costs and such lead to reduced economic activity. And, the point of this is, the Fed raising rates, assuming they are able to, in a sort of normal cycle, they prick bubbles and such, and they may eventually do so until they cause a recession. And of course, that isn't good for home prices as well, because you have reduced, depression or recession in the economy, reduced economic activity, layoffs and such. I mean, that, as you can imagine, obviously isn't a positive for the real estate market either. So there you have it. We hope you found this video helpful. Please definitely check out our other videos on this topic as well. Why we think this isn't a sort of a normal sort of rate hike cycle that's just going to go as smoothly as it's done in the past sort of couple of decades. And if you have any questions, please leave us a comment below. Hit like or subscribe. We hope you find these updates helpful. My name is Chris at Hauseit. We can help you save up to 6% when you sell with an agent-assisted FSBO listing. And if you want something more hands-on, we have a 1% for full service listing option, where one of our agents handles everything for you. You can sit back, relax, and pay a reduced listing fee. And of course, if you're looking to buy, we can help you save 2% or more by giving you 2/3 of the buyer agent's commission, subject to us keeping a small minimum of 1% or $7,500 as of this writing. It can be quite a bunch of money because, especially here in Miami, many new construction projects will offer significantly more than the traditional 3% to buyer's agents. They may offer, for example, at the Masoni Baya, 7% to buyer's agents, and 2/3 of that can cover your closing costs and more. So we hope you found this video helpful. My name is Chris at Hauseit, and we'll see you on the next one.